this little cheat sheet, I want you to say assets, debit balance. Okay? Then, because in every asset you have, debits are going to exceed credits. They will. Liabilities, credits should always exceed debits. So, in a liabilities section, this is going to be a normal credit balance. Okay? Now, I'm going to tell you this. The normal balance is the side that increases. Okay? So, let's just say when we receive supplies on account, what happens to our supplies? They increase. So if an asset has a normal debit balance, and the normal balance is usually the side that gets increased, that would be when we receive supplies on account. When we receive those supplies, we're going to increase our supply account, which means debit it.
And credit accounts payable.
And then on the other hand, if we're buying these supplies on credit and we have to increase our accounts payable, and if liabilities have a normal credit balance, then that means we're going to have to credit accounts payable. So do you see we have two accounts, one we debited, one we credited. Okay, hang in there with me. This is probably the toughest part of accounting, is this chapter. So, investments by stockholders and revenue help increase the stockholders' equity section. Okay, so we credit those accounts to increase the stockholders' equity section. So let's go back to our little cheat sheet. When we have common stock, okay, the common stock here has, when we increase, okay, let me just say, when we increase stockholders' equity, we credit it. Okay? That's the normal balance. So items such as revenues all have a normal credit balance. When we decrease stockholders' equity, such as paying dividends or having dividends or declaring expenses, we're decreasing the stockholders' equity section, which means we're going to debit those two accounts. So expenses and dividends have normal debit balances, because if we know our stockholders' equity section, to increase it has a credit balance, those accounts, if we're decreasing stockholders' equity, they're going to have a debit balance. So we're going to show here that expenses have a normal debit balance, and we also know that dividends have a normal debit balance. So you know, when you look at the accounting equation, assets, when they increase, will just be a normal balance of a debit. Liabilities and stockholders' equity section, which is the other side of the equation, are going to have a normal credit balance, which means when you increase them, you credit them. But there's two aspects to stockholders' equity that reduces the stockholders' equity accounts. What are they? Dividends and expenses. So those two accounts dividends and expenses, because they reduce stockholders' equity, we're going to debit them. Because again, the normal balance of stockholders' equity is a credit balance. Does that make sense? How are you guys doing so far? Kinda?
Chapters 1 and 2 are great.
Okay, so let's move on here. Hang in there. You're going to be fine.
Clear as mud, right, Erin?
Okay, great. So, investments and revenues increase the stockholders' equity section. Therefore, we're going to credit that account. Dividends and expenses reduce the stockholders' equity section. Therefore, we'll debit those accounts because we're reducing stockholders' equity. So, see here, the normal balance of stockholders' equity is a credit. When we reduce stockholders' equity, we debit it. So, with common stock, when our common stock goes up, we credit it. When our retained earnings goes up, we credit it. But when our dividends increase, which means we pay more dividends, it's going to reduce stockholders' equity, so we need to debit it. But the dividends account is going to have a normal debit balance because it does the opposite. It reduces stockholders' equity. Okay? So,
That's the same for expenses, right?
correct. Revenues are like capital. It increases the stockholders' equity section, so we're going to credit that account. But expenses decrease the stockholders' equity section, so we're going to debit that. But the expense accounts are going to have a normal debit balance because the job of all expense accounts is to decrease stockholders' equity. So they're going to be debits. Okay? But the normal balance of an expense account will always be a debit. So, as you see here, the stockholders' equity section consists of common stock, and then it consists of retained earnings. Now, our retained earnings section basically shows a beginning balance. We're always going to, unless it's a brand new company that just started this year, we're always going to have a balance we bring into the retained earnings section of all the income made during all the existence minus all the dividends. So we start retained earnings with a beginning balance. Then we are going to add into retained earnings the net income. Another way to think of it, we're going to add into retained earnings, add all the revenues, subtract all the expenses to have an ending retained earnings balance minus your dividends. Or to keep it simple, we just flow into net retained earnings the net income. All the revenues minus the expenses are going to come up with the net income. We'll flow that into retained earnings. Do you see how it's the same thing? And then, if we pay out dividends, we're going to be decreasing retained earnings, so we've got an ending balance. So no, retained earnings starts with a balance. We add to it our net income. We subtract from it dividends, and we have an ending balance. What if instead of having net income, we have a net loss? Well, that's going to take away from our retained earnings, won't it? So if there's a net loss, we're going to start with a balance. We'll subtract from it the net loss. And if we have dividends, subtract the dividends. The purpose of net income is to increase our earnings. If you have a net loss, you're decreasing that retained earnings. Make sense? So, assets and expenses have a normal debit balance. Initially, guys, you're just going to have to memorize this. And then as we start doing problems, it's just going to start sinking and make sense. But liabilities, the stockholders' equity, and revenues have a normal credit balance. So, when we have an asset, if we increase our asset, we're going to debit it. If we have a liability and we debit a liability, that is going to, okay, so basically here, when we increase an asset or we increase an expense, we're going to debit them. When we debit a liability, an equity, or a revenue, the debit side decreases the balance. On the opposite, for an asset and an expense, when we credit it, we're decreasing it, okay? Because the normal balance will be what's in blue. That will be the normal balance. And so for assets and expenses, the normal balance is a debit because that increases it. When we're dealing with liabilities, revenues, and stockholders, the equity section, the normal balance is a credit balance, you see, because that's increasing it. Okay? So, the relationship among the assets, liabilities, and stockholders' equity of a business, the assets have a normal debit balance. Do you see how the liabilities have a normal credit balance? Common stock has a normal credit balance. Retained earnings has a normal credit balance. But if we pay out dividends, that's going to have a normal debit balance. Expenses are going to have a normal debit balance. And our revenues are going to have a normal credit balance. I am going to stop now and we are going to start doing some problems. We have just gained, we've just looked through a ton of information here. Okay? So, now what we're going to do is go back here and look in the book and let's look here at brief exercise 3.1. Okay? Presented below are 3 economic events. On a sheet of paper, list the letters A, B, and C with columns for assets, liabilities, and stockholders' equity. In each column, indicate whether the event increased or decreased or had no effect on assets, liabilities, and owner's equity. So what I'm going to do is I'm going to create a sheet that has assets, or is it stockholders' equity? So I'm going to basically create 3 sections, okay? And we're going to have A, B, and C. So we're going to go back to the book and read the first transaction. We purchased supplies on account. So when we purchase supplies on account, what happens to our supplies?
Go up.
They go up. What type of an account would supplies be? Asset.